What if I told you that one of America's largest and most disciplined investment funds, ISNT, run by Wall Street billionaires, isn't controlled by Silicon Valley venture capitalists, and doesn't belong to a government pension system? What if I told you it belongs to a church? Not a flashy, not a celebrity ministry, but a religious institution built on 19th century pioneer roots, the Church of Jesus Christ of Latter-day Saints. For decades, while markets crashed, bubbles burst, and banks collapsed, this institution quietly accumulated tens of billions of dollars in assets. No commercials, no investor roadshows, no IPO, just steady cash flow, silent compounding, and extraordinary financial discipline. So here's the mystery. How did a church funded mostly by everyday members build one of the largest investment funds in America without most people ever noticing? And more importantly, what does this reveal about how long-term wealth is really built in the modern financial system? To answer that, we have to go back not to Wall Street but to wagons, deserts, persecution, and survival economics. The financial mindset of the Mormon Church did not start with spreadsheets and hedge fund strategies. It started with survival. In the early 1800s, members of the LDS Church were repeatedly forced to relocate from New York to Ohio, Missouri, Illinois, and eventually westward to Utah. They faced violence, displacement, and loss of property. This trauma shaped a deeply ingrained institutional instinct, self-reliance, and long-term preparation. Brigham Young, who led the Mormon pioneers west, didn't just organize religious communities, he organized economic systems, farms, cooperative stores, local industries, tithing systems, infrastructure. The goal wasn't luxury, it was resilience. From the beginning, the church encouraged members to store food, avoid unnecessary debt, and contribute resources collectively. These weren't spiritual metaphors, they were economic survival strategies. This culture created something rare, a population trained to think long-term instead of short-term, and that mindset would eventually become the foundation for something far bigger than anyone imagined. The core engine behind the Mormon Church's financial power is surprisingly simple: tithing. Members are encouraged to contribute approximately 10% of their income. Unlike donations that fluctuate with emotional fundraising campaigns, tithing is structured, consistent, and culturally reinforced. This creates a financial phenomenon most organizations dream of: predictable cash flow, global diversification of income sources, high participation rates, cultural commitment rather than transactional giving. For decades, this money funded churches, humanitarian programs, education systems, and operational costs. But something else was happening quietly behind the scenes. Instead of spending everything that came in, church leaders began saving aggressively. Surpluses were not treated as temporary leftovers. They were treated as long-term capital. And unlike many institutions that chase risky speculation, the LDS financial strategy leaned heavily into conservative, disciplined investment principles, index-style diversification, long holding periods, minimal leverage, quiet reinvestment of profits, no flashy headlines, just compounding. By the late 20th century, the church's financial operations had become large enough that informal management no longer worked. So in the 1990s, a new structure quietly emerged: Ensign Peak Advisors. This organization was created to professionally manage the church's investment assets. It wasn't marketed publicly. It didn't seek outside investors. It functioned internally, staffed by experienced financial professionals. Its mission was simple: preserve and grow long-term reserves. And here's where the story gets interesting. Ensign Peak didn't chase trendy startups or speculative bubbles. Instead, it focused heavily on traditional financial instruments: stocks, bonds, mutual fund-style portfolios, blue-chip corporate holdings. Think less Silicon Valley venture fund and more ultra-patient institutional investor. While most organizations struggle with emotional decision-making, panic selling during crashes, and greed buying during bubbles, Ensign Peak had something rare. No pressure from public shareholders. No quarterly earnings calls. No short-term performance demands. That freedom allowed one of the most powerful forces in finance to operate without interruption: compound growth, year after year, decade after decade. Here's the key cause and effect chain that transformed tithing into billions. 1. Stable contributions created predictable capital inflow. 2. Low spending relative to income preserved surpluses. 3. Professional asset management optimized returns. 4. Long holding periods avoided emotional market mistakes. 5. Reinvestment of profits, accelerated compounding. Most organizations fail at step 2. They spend what they receive. Most investors fail at step 4. They panic during downturns. The Mormon Church succeeded because its structure removed many of the psychological weaknesses that destroy long-term wealth. And over time, this created something extraordinary. A financial reserve so large that even insiders reportedly struggled to grasp its scale. What made this investment fund especially unique was not just its size, but its invisibility. Unlike corporations required to publish earnings reports, the church operated with minimal public financial disclosure. That meant that growth happened quietly. While news cycles focused on tech billionaires and hedge fund managers, a religious institution was steadily becoming one of America's largest institutional investors. This silence wasn't accidental. It was strategic. Low visibility reduced political pressure. Low attention avoided public scrutiny. Low noise allowed uninterrupted accumulation. And for years, it worked. Until one event changed everything. In late 2019, a former employee inside the system filed a whistleblower complaint. Suddenly, headlines began to surface. Reports claimed that Church's investment reserves had reached staggering levels, estimates ranging into the tens of billions of dollars. For the first time, the public began asking hard questions. Why was so much money being stockpiled? How transparent should religious institutions be? What responsibilities come with that scale of wealth? This wasn't just a financial controversy. It became a moral, social, and political debate, and it exposed a deeper tension, the collision between spiritual institutions and modern financial power. But this moment didn't destroy the system. It simply revealed it. And what happened next would reshape how people viewed institutional wealth forever. After the whistleblower revelations, government agencies and journalists began investigating the structure of the church's investment entities. For the first time, terms like shell organizations, reporting structures, and asset concealment mechanisms entered mainstream discussion. To be clear, this wasn't about criminal conspiracies in the Hollywood sense. It was about how large institutions legally structure finances to reduce visibility and regulatory friction. Many massive funds operate this way. Universities, foundations, sovereign wealth funds, and corporate investment arms use similar techniques. But when the institution involved is a church, public reaction becomes far more emotional. Critics asked, should tax-exempt religious organizations hold massive investment portfolios? Should donations meant for spiritual purposes be used for long-term financial accumulation? Should members be informed more transparently about how funds are managed? Supporters argued the opposite. Financial reserves protect humanitarian programs. Stability prevents future crises. Independence reduces reliance on outside donors. And suddenly, the conversation wasn't about money anymore. It was about trust. Here's the uncomfortable truth. This conflict was predictable. When any institution grows beyond a certain financial size, three forces collide. 1. Public expectation. People demand accountability. 2. Regulatory attention. Authorities examine compliance. 3. Internal pressure. Members want clarity. The Mormon Church crossed that threshold quietly. And when the public finally realized how large the investment fund had become, the reaction wasn't surprise, it was shock. Not because wealth existed, but because it had accumulated in silence. In modern society, secrecy is interpreted as suspicion, even when legal. And that perception alone created reputational damage no balance sheet could fully offset. After exposure, many assumed there would be a dramatic transformation. Full public financial disclosures, major restructuring, radical transparency reforms. But that didn't happen in the way critics expected. Why? Because institutions built on long-term stability resist sudden structural changes. Here's why quick fixes often fail. Transparency increases political pressure. Public reporting attracts external influence. Visibility creates new reputational risks. From an institutional perspective, revealing everything creates vulnerabilities that didn't previously exist. So instead of radical transparency, what followed was something far more common in large organizations: controlled adjustments, compliance, refinements, policy clarifications, legal restructuring. Enough change to satisfy regulators, not enough to disrupt the core system. And this pattern is not unique. What makes this story truly important isn't the Mormon Church itself. It's what it reveals about modern wealth architecture. Across the world, similar structures exist. University endowments managing tens of billions, sovereign wealth funds quietly accumulating national surplus, non-profit foundations investing donor capital, corporate cash reserves rivaling small countries. They all follow the same blueprint. 1. Stable capital inflow. 2. Long-term investment horizons. 3. Minimal public pressure. 4. Professional asset management. 5. Compounding over decades. The Mormon Church didn't invent this system, it simply applied it with exceptional discipline. Here's the pattern most people miss. The biggest financial winners aren't always the loudest investors. They are the quiet institutions that avoid emotional trading, ignore media panic, stay invested during crashes, reinvest profits instead of consuming them, think in generations instead of quarters. While individuals chase fast returns, institutions quietly build permanent capital. This is why endowments outperform retail investors, why sovereign funds dominate markets, why long-term capital always beats short-term speculation. The Mormon Church simply became a case study in how powerful this approach can be. And now we arrive at the uncomfortable philosophical question. If a religious institution accumulates enormous wealth, what is the ultimate purpose? Security, influence, charity, survival, power. This is where opinions diverge. Some believe large reserves ensure humanitarian stability during future crises. Others argue excess accumulation contradicts spiritual principles of charity and humility. And that debate doesn't have a simple answer, because wealth itself is neutral. It's the intentions behind it and the transparency surrounding it that shape public trust. Let's break this story down into 3 powerful lessons anyone can learn from. The Mormon Church didn't build wealth through risky speculation. It did it through consistency, predictable inflows, conservative investing, long-term holding. This reinforces a truth many ignore. Slow money beats fast money when time is allowed to work. Individuals live paycheck to paycheck. Institutions plan decades ahead. They structure systems that remove emotion, automate discipline, and optimize compounding. Understanding this gap explains why wealth concentration keeps growing globally. In the digital age, secrecy becomes harder every year. Whistleblowers, data leaks, financial filings, and investigative journalism ensure that even the quietest financial empires eventually become visible. The real question is not if exposure happens, but how institutions respond when it does. Here's the warning most people overlook. As more institutions accumulate massive financial power, the line between spiritual organizations, corporations, and political influence becomes increasingly blurred. When wealth concentrates quietly, decision-making power concentrates with it. And that affects markets policy, social influence, resource allocation. Ignoring this reality doesn't make it disappear. It simply allows it to grow unchecked. So here's the question I'll leave you with. If you had the ability to build a financial system designed to last 100 years, would you prioritize transparency or protection, charity or reserves, public accountability or institutional independence? Because every large organization eventually has to make that choice, and history shows us the consequences of that choice that go far beyond balance sheets. If this breakdown changed how you see institutional wealth and long-term investing, I'd like so more people discover this story. Subscribe if you want more deep investigations into hidden financial systems, economic power structures, and the forces shaping the global economy. And comment below. Do you think religious institutions should be required to fully disclose financial holdings, or should independence be protected? Your answer might say more about the future of money than you realize.